Joining me now, David Garofalo, CEO, Chair, and President of Gold Royalty. Always good to see you. Thanks.
Good to see you too, Mark. Thank you for having me.
Yeah, thanks for dropping by. So let's go macro first, and then we'll get to Gold Royalty as well. So gold, as we know, within spitting distance again of all-time highs. Do you think the one main driving force is global debt? And then you've got the Trump administration coming in, and is there any way that the debt won't go up under Trump? And gold will stay elevated.
No, it really didn't matter who won the election. They're hooped either way. Debt is growing at the rate of about $5 trillion a year in the U.S., including debt service and looking at the deficit. The only way to deal with debt is to inflate it away. And it's inevitable. I mean, 80% of the U.S. budget is essentially non-discretionary. So even cutting around the margins isn't going to solve the debt crisis. They need to make the U.S. currency continue to depreciate in order to depreciate the debt as a percentage of GDP.
The U.S. dollar has rolled over a little bit, but it has been strong for several months. As you know, we know that U.S. Treasury yields have been going up, as has gold, which is sort of counterintuitive. Wouldn't you say? Do you find that a little surprising that gold is holding up in that environment so well?
Not at all, because what happened over the last 50 years is really a one-way trade of gold against every fiat currency, and in particular the U.S. dollar. If you go back to when the government abandoned the gold standard in the early 1970s to today, gold's gone from $35 an ounce to $2,800, and the purchasing power of the U.S. dollar has gone down 96%. And that's not that's a common phenomenon across all the fiat currencies, particularly in the Western world. Inevitably, when you unmoored from any physical standard, the temptation to print and debase fiat currencies is just too significant for any government or central bank.
I don't have the numbers off the top of my head, but I remember talking with Pierre Lassonde, Rob McEwen, two of your peers, and we went way back to the Romans and the silver denarius, where they kept chipping away at it. It was the same thing, the same depreciation of their currency. Now, just back to Trump, and then you got Musk and Ramaswamy and this Doge committee, and they're talking a good game about it. We're going to cut $2.5 trillion from the deficit. You just don't buy that?
It's not enough. And again, they don't have the capacity to cut $2.5 trillion. 80% of it is really military, debt service, social programs. There's a limit to what they can cut, and I would say the vast majority of the budget in the U.S. is completely non-discretionary. So they can just really trim at the margins.
So for Gold Royalty, first 9 months of 24, record revenue, and you described companies looking for capital, exploration companies as kind of going through a nuclear winter. Are they still experiencing that now? And does that benefit Gold Royalty in terms of being able to size up properties and to finance them?
Yeah, I mean, the access to capital markets has been non-existent for juniors for a dozen years, other than on a very, very selective basis. If they have some sponsorship from a senior company that has a particular interest in their specific property. But by and large, we haven't seen that kind of wholesale investment in grassroots exploration to replace depleting reserves. And as a result, we've seen a 40% decline in reserves in the gold industry. And all the big producers have been able to do is cannibalize each other. And I hate to pick on the big guys, but if you look at the Barrick and Newmonts of the world, they're at the same production and reserve level they were back in the mid-1990s. The only thing they've been able to grow in 30 years is their share count. And that's, as a result, meant that their share price is actually lower than it was when the gold price was a tenth of what it is today.
And you made that point that when Newmont bought Goldcorp, when you were there, they were hoping to grow their reserves, and that didn't really happen.
No, and they actually ended up divesting of a large majority of the assets they inherited from Goldcorp, and then took over Newcrest in an even bigger deal, just to get back to the production profile they thought they could deliver through the consolidation of Goldcorp. So it's a never-ending treadmill of cannibalization, consolidation that the big guys have to do because they're at suboptimal production and reserve levels in the context of the lack of discoveries being made by juniors who have not had access to capital over the last dozen years or so.
Now, in terms of Gold Royalty's shares, it seems like the market is not rewarding it for any good news. Why do you think that is compared to some of the other royalty companies?
We have by far the best growth profile among the royalty companies, even among the larger cap players. The larger cap players, by and large, are ex-growth anyways. They're so big. They're great companies, but they're not going to grow off the production base that they have. So right now in this market, growth is a dirty word. Growth implies that there's risk, and as a result, that risk is severely discounted. But we're now in the midst of crystallizing that growth. We're looking at 60% compounded annual growth in our revenue right through the end of the decade. And for the first time in our history, we're free cash flow positive in 2025, earnings positive. So we've turned the corner, and as a result, we expect to see a significant re-rate in our stock We've been significantly discounted because of the growth embedded in our business, but now we're delivering on that growth.
So investors will eventually figure it out. It just takes time.
It's an efficient market.
All right. Thanks, David.
Thanks for having me on.
All right. Good stuff. David Garofalo. He's the head guy at Gold Royalty.